tanked quite a bit. So that was Greece cotton for you. But shifting focus and welcoming the first guest on the show, we have with us Mr. Ajay Vora, Head of Equities Nuvama Asset Management, joining us on the show. Hi Ajay, good to have you on board. Thank you so much for making time and speaking with ET now. To begin with, what's your first reaction coming in from the RBI decision? The overall commentary was again very balanced. There were hawkish tones to it, dovish tones to it. Said the tomato and other prices are expected to come off sharply. But then this incremental CRR. That's having a bit of a negative impact on the banking names as well. What's your reading of this?
So hi, good afternoon, and thanks for having me on the show. So broadly, if you look at the governor has built an amazing credibility post COVID in terms of the way they have managed the economy and the system liquidity. I think the current the action also what they have done on the CRR on the incremental NDTL. I think it is also a good move because you have inflation pressures cropping up again across the world and also in India because of food prices. I think the additional liquidity which is there in the system is something what the governor has decided to suck out, and maybe they have been pretty flexible with their actions. So what they have mentioned is that in September meeting again they'll take a call on if some revision needs to be done. So I think in a way I don't think it is a material change for the overall system, but definitely, they will continue to do things which are good for the economy and the system liquidity.
Okay, so not a material change coming in, and for now at least it's temporary. Let's see what that September 8th reconsideration brings in. So does that mean, Ajay, that you're holding out for financials to be one of the top preferred sectors? And within that as well, is it getting a lot more diverse in the sense of the mid-tier bank and even the low-rung banks, the likes of RBL, etc., and even in terms of the other NBFCs that you're looking at incrementally positively, the microfinance lenders?
So honestly, on the overall banking sector, if you look at it, considering the last quarter results, we have seen a NIM compression across most of the players, and that has been a little more than what the market was expecting. And now with the view, getting established that the rates are unlikely to come down in the near term. In fact, they will go a bit higher. There can continue to be a little bit of more pressure on the NIMs. So although the credit growth is still very strong, although it has come off from the highs due to falling inflation, but the point is that there is unlikely to be any material earnings upgrade for most of the banks in the near to medium term. So we would be pretty neutral rather than being overweight on the banks right now in for the near to medium term.
Interesting. So you're saying there are no further triggers as such for the banking names. Upgrade seems to be slowing down. So that's why getting into a bit of a market weight per se for the banking sector. But what about consumption? Because earnings this time from the entire FMCG and urban discretionary space has been very divergent. You had a Safari which reported a great set of numbers. VIP was very bad. Trend reported great set of numbers. Aditya Birla Fashion was pretty weak. What's your take as to how the entire consumption trade is panning out? Is it that the urban discretionary names are doing a lot better and the likes of V-Mart, etc., which is a lot more mass, is actually underperforming?
No, so you are absolutely right. I think the names and the examples which you gave are you are bang on that. So it is pretty selective right now, and I think one more quarter of a subdued volume growth. But my sense is that with the onset of the festive season post say September onwards, you'll again start seeing consumption doing pretty well across most of the categories. So players who have really established, or I would say a strong foothold in terms of their product, in terms of pricing, and in terms of their target customers. Someone like a Trend is doing exceedingly well, but someone like a Aditya Birla Fashion, where they have acquired a couple of businesses and they are investing in all the new categories, they are finding it a pretty difficult right now to extract the volume growth. So it is all stock specific. Certain players are finding it difficult, but that is what the market is now going to be, where it will get narrower, and we'll have to focus more on stocks and companies which are likely to grow far more than the market. So it is a great opportunity for the money managers to deliver alpha, where the markets remain sideways, and you end up buying stocks which can actually grow and compound at a higher rate.
Sure, time to get very, very stock specific. But there's also the pharma sector where you need to be very, very stock specific as well, right? Each company has their own issues, whether it's export facing, domestic facing, CDMO, etc., and even the diagnostic and the hospital space. Within that, is there any specific pocket that you would want to call out as an outperformer or outlier?
So, pharma is something which we have been pretty positive since I would say 2 quarters back or 3 quarters back. And at that time, the valuations were pretty reasonable. And most of the entire market was considering IT as more of a defensive sector. But the revenue growth collapsed in that sector versus if you look at, the quarterly earnings which most of the pharma companies reported, they have delivered a decent surprise versus the market expectation. So both on, the pricing front as well as the volume front, we have seen very good numbers from most of the large and mid cap companies. So I think that certain players who are more, I would say, API focused or more generic focused, where the pricing erosion is more or less done, I think they can still continue to do well. Someone like Sun Pharma also, who has been doing very well on the specialty side, they are gaining a lot of traction. So honestly, the sector was having a significantly lower weightage across most of the portfolio for a fairly long time, and now with earnings also coming back and valuations not that expensive, I think that market will continue to give a thumbs up to this sector in the near to medium term.
Sure, hold that thought, Ajay. Just wanted to spot some of the stocks which are reacting. Tata Motors has just seen a very large deal happening, almost 1% equity has changed hand. So let's pull up the intraday chart if we can of Tata Motors, because that stock is perking up as we speak. And similar is the case with Tata Motors DVR. Let's pull up the intraday charts of both those counters. Yes, you see that V-shaped move coming in for Tata Motors and Tata Motors DVR as well. On the other hand, it's Chalet Hotels which is tanking. So on an incremental basis, the move doesn't seem very incremental, but that one is down a solid 4.5%. And Bajaj Electricals too is on the back foot with a cut of around 2%. Ajay, coming back to the conversation, the other theme that everybody seems to be seeing as a consensus trend or a fad or a trade right now is manufacturing, whether it's electronic manufacturing, whether it's industrials. What's your view in terms of how to spot the right names? Because defense is a very long gestation period. This electronic manufacturing vertical has run up substantially. Do you still see value in any of these names?
So, talking specifically about the defense sector, the opportunity definitely is very large. But if you look at, all these companies, they don't end up, executing the way market expects them to execute. So it obviously takes time considering the nature of the business. And if you build in the numbers, most of the stocks are trading pretty expensive versus what they can deliver over next 3 to 4 years. So it is maybe, all these names in the defense sector can go in a consolidation phase and may not correct much, but we are not pretty much positive from the current levels in terms of the compounding can continue for next 1 to 2 years. So that is on the defense side. But coming back to the manufacturing theme, what you're talking about, there we are specifically focused on certain companies which are more US export focused and more to do with the goods part rather than services. Because we think that the whole US, I would say the distributor level inventory across categories, they have been running pretty low for a fairly long time because everyone was fearing recession. And now, the whole narrative changing that even if the recession hits them, it won't be that deep. And in fact, if you look at the consumer data that has been pretty strong in US, which is holding up the overall growth rates, my sense is that the export goods exporters to US, having their own integrated manufacturing base over here, can see a massive rebound, considering they can have a restocking in US, and on top of it going into the year end and the festive season, you can have a decent growth as well. So there are quite a few businesses and categories who are focused on this particular theme, which can gain traction from here.
Ajay, on that note, I'll let you go. Thank you so much for making time and speaking with us. In the meantime, pull up the intraday chart of Ipca Laboratories as well. I think the company just reported its numbers.